Hello, what's up, guys? Welcome back to Zodiac Trader. So, in last video, we were talking about how to sell naked call. So here we will have an example, and we will explain other strategies as well. So this is an example of a naked call writing, which is that you're trying to sell a naked call. What what does it mean by naked is that you do not have any underlying asset as a hedge. So if you're selling AAPL, which is Apple, if you're selling naked Apple call, that means you do not own the stock, the Apple stock, and you only sell the AAPL call. So that could be risky. So here, this is an example. So if the price of the XYZ rose to $60 at expiration, the naked call writer will suffer a $10 loss on the purchase and sale of the shares, which means that you buy at $60 and you sell at $50. So this loss is offset somewhat by the initial premium of $4.55. So that the actual loss is $5.45 per share or $5,450 in total. So that's $5.45 multiplied by 100 shares times 10 contracts. So you have also another put option strategy that you can buy puts. So normally when you buy puts, you're trying to hedge against the downside risk that you're buying for certain insurance protection. So investors buy put option for A, to profit from an expected decline in the price of the stock. Speculative strategy relies on the fact that put option price tend to rise as the price of the stock falls, just like buying calls. The selection of an expiration date and strike price is crucial to the success or lack thereof of the strategy. B. For risk management purposes, puts can be used to lock in a minimum selling price for stock. So they are very popular when investors who own stock. So you can buy puts, you can protect investors from decline in the price of a stock below the strike price. So either you go speculate on the downside of a stock, or you can hedge yourself against the downside risk. So there are different purposes for buying put options. So here is a strategy to buy puts to speculate. That means you are trying to buy put to bet on the downward movement of the stock price, the fall of the stock price. So assume an investor buys 10 XYZ September 50 put options at the current price of $1.50. The put buyer pays a premium of $1,500, which is 1.5 times 100 shares times 10 contracts, to attain the right to sell 1,000 shares of XYZ in comp at $50 a share on or before the expiration date in September. Because the options are out of the money, the strike price is less than the stock price. The 1.50 premium consists entirely of time value. The option has no intrinsic value. Opinion of put buyer might be the exact opposite of the opinion of put seller. If the stock price falls, the XYZ September 50 put options will likely rise in value. This will allow the put buyer to sell his options for profit. Of course, if the stock price rises, the put options will most likely lose value, and the put buyer may be forced to sell the options at a loss. For example, if XYZ stock is trading $45 1 month before September expiration date, the XYZ September 50 puts will be trading for at least their intrinsic value or $5. Since there is still 1 month before expiration date, the option will still have some time value as well. So assuming they have the time value of 0.25, the options will be trading at 5.25. Therefore, the put buyer could choose to sell the puts for $5.25 and realize a profit of $3.75 per share, which is equal to the difference between the current put price and the put buyer's original purchase price. So based on 10 contracts, the put buyer's total profit would be $3,750. That's 3.75 times 100 shares times 10 contracts. But if XYZ were trading at $60 a share, the XYZ September 50 puts might be worth only $0.05 because the options are so far out of money because there is only 1 month left until the options expire. The options would not have a lot of time value. The low option price tells us the market does not believe there is much of a chance of XYZ share to fall below $50 anytime over the next month. So put buyers has to decide whether to sell the options at this price or hold on in the hope that the price of XYZ does fall to below $50. If the stock does fall, the price of puts will rise. If the stock doesn't fall below $50, the puts would be worthless when it expired. If the put buyer decided to sell options at $0.05, a loss equal to $1.45 per share, which is 0.05 minus 1.50, or $1,450, for example. So that would be 1.45 times 100 shares times 10 contracts. So strategy number 2, that you can buy puts to manage risk, to hedge against the downside. So assume an investor buys 10 XYZ September 50 put options at the current price of 150. But in this case, the put buyer actually owns 1,000 shares of XYZ. Thus, the put purchase acts as an insurance against a drop in the price of the stock. So record that put buyers have the right to sell the stock at the strike price. So buying a put in conjunction with owning the stock, a strategy known as a married put or put hedge, gives the put buyer the right to sell the stock at the strike price. If the price of stock is below the strike price of the put when the put expires, the put buyer would most likely exercise the puts and sell the stock to the put writer. The strike price acts as a floor price for the sale of the stock. Strategy number 2, buying puts to manage risk. For example, if XYZ shares are trading at $45 just prior to the expiration date in September, the puts would be trading very close to their intrinsic value of $5. Because the puts are in the money and there is very little time left until the expiration date, the put buyer may choose to exercise the puts and sell the stock at the $50 strike price. The put buyer has been protected from the drop in the stock price below $50. The protection was not free because the put buyer had to pay $1.50 for the puts. The put buyer effective sale price is actually only $48.50 after deducting the cost of the puts. But this sale price is still better than the stock $45 market price. So the put buyer may not want or even be able to sell the stock. If so, the puts should be sold. Any profits on the sale of the puts reduces the put buyer's effective stock purchase price. If the put buyer originally bought the stock at price of $40 and then sold the puts at $5 for a net profit of $3.50, the effective stock purchase price becomes $36.5. Sorry for that mistake. Eventually, when the shares are sold, the put buyers will measure the total profits on the stock purchase as the difference between the sell price and the effective purchase price of $36.5. So, okay, here we talk about writing put options. That means you're trying to sell put options. So this is primarily done for the income they provide in the form of premium. So in a sense, you're trying to collect the insurance premium, then you're trying to collect the option premium. You try to sell the insurance. So as our previous example, as an insurance company, you are obliged to pay out your customer if they got hit or injured. But if the people, your customers, are not getting any injury or not any accidents, what they have to do is that they have to keep paying you for the insurance fee. For that insurance fee, that's option premium. So the writer to keep, no matter what happens, the price of underlying assets or what the buyer eventually does. So similar to call writing, put writing strategies are primarily speculative in nature, but they can also be used to manage risk. So put option writer can be classified as either covered or naked. So covered put writing is not nearly as common as covered call writing because technically a covered put writes combines a short put with a short position in the stock. More common is a nearly covered put writing strategy is known as a cash secured put write. A cash secured put write involves writing a put, which is mean that you're selling a put and setting aside an amount of cash equal to the strike price. So naked put writers have no position in the stock and not specifically earmark an amount of cash to buy the stock. They must be prepared to buy the stock, so they should always have the financial resources to do so. So they hope to profit from the stock price that stay in the same or goes up. If this happens, the price of the puts will likely decline as well, and the chance of being assigned will also be less. The naked put writer may then choose to buy back the options at lower price to realize a profit. If the stock price does not rise, the put writer may be assigned and may suffer a loss. So based on how low the stock price is and the amount of premium received, naked put writers may still profit even if they are assigned. So strategy. Number one, cash secured put writing. So in this case, assuming investors write 5 XYZ December 55 put options at a current price of $4.85. The put writer receives a premium of 2,425, which is 4.85 times 100 shares times 5 contracts to take on the obligation of buying 500 shares of XYZ Inc. at $55 a share on or before the expiration date in December. Because the options are in the money, the strike price is greater than the stock price. The 4.85 premium consists of both intrinsic value and time value. Intrinsic value is equal to 2.50 and the time value equals to $2.35. If the put writer set aside cash equal to the purchase value of the stock, the strategy is known as a cash secured put write. The put writer in this case would have the set aside of $27,500. So that would be 55 strike price times 100 shares times 5 contracts. So some investors actually use cash secured puts rights as a way to buy the stock at an effective price that is lower than the current market price. The effective price is equal to the strike price minus the premiums received. So here, this is cash secured put writing. For example, if at expiration in December the price of XYZ stock is less than $55, the put writer will be assigned and will have to buy 500 shares of XYZ at a strike price of $55 per share. The effective purchase price is actually 50.15 because the put writer received a premium of $4.85 when the option was written. This effective purchase price is less than the 52.5 price of the stock when the cash secured put right was established. So if at expiration in December, the price of XYZ stock is greater than $55, the cash secured put writer will not be assigned because the options are out of money. The cash secured put writer, however, gets to keep the premium of $4.85 and will have to decide whether to use the cash to buy the stock at the market price. Second strategy, naked put writing. So suppose that different investors writes or sell a 5XYZ December 55 put option at the current price of $4.85. If the put writer does not set aside a specific amount of cash to cover the potential purchase of the stock, the put writer is considered a naked put writer. The naked put writer desires the price of XYZ to be higher than $55 at expiration. If this happens, the puts will expire worthless and the put writer will earn a profit equal to $4.85 per share, the initial premium received. If the price of XYZ stock falls, the naked put writer will most likely realize a loss, as put buyers will exercise their options to sell the stock at the higher strike price. So the naked put writer in this case will suffer a loss only if XYZ stock is trading for less than $50.15 at option expiration. So the naked put writer will have to buy back the stock at the price that is higher than the market price. So if the put writer does not want to hold the shares but this anticipation of a higher price, they should be sold. For example, if the price of XYZ fell to $45 expiration, the naked put writer will suffer a $10 loss on the purchase and sale of the shares. So you have to buy at the strike price of $55, sell at the market price of $45. So this loss is offset somewhat by the initial premium of $4.85, so that the actual loss is $5.15 per share, or $2,575 in total. That's 5.15 times 100 shares times 5 contracts. So option strategies for corporations. Normally, corporations do not speculate with derivatives. They are interested in managing risk and often use options to do it. These risks are often related to interest rate, exchange rate, or commodity price. For example, corporations take on debt to help finance their operations, and at times the interest rate on the debt is a floating rate that rises and falls with the market interest rate. Like for example, right now the interest rate is high, so corporations are exposing to high interest rate risk. So just like the investor who buys a call to establish a maximum purchase price for stock, corporations can buy a call to establish a maximum interest on floating rate debt. So here, this is the call option strategies corporations. So suppose the Canadian company knows it will buy US $1 million worth of goods from a US supplier in 3 months' time if the exchange rate is called 1.12 per US dollar. The US dollar purchase will cost the company $1.12 million. So the company can either buy the US $1 million now or pay a call $1.12 million or wait 3 months to pay whatever the exchange rate at this time. If company chooses to do the latter and wait, by doing this it faces a risk that the value of the US dollar will strengthen related to Canadian dollar. Thus, the Canadian dollar cost of the purchase would be higher than Canadian dollar 1.12 million. So to protect itself against this risk, the corporation can buy a call option on the US dollar. So basically hedging the forex risk, like the currency risk. So call option strategies for corporations. Suppose the corporations buys a 3-month US dollar call options with a strike price of Canadian dollar $1.15. So this option is an OTC option and will likely to be written by the corporation's bank. If at the end of 3 months the exchange turns out to be Canadian $1.2, the corporation will exercise the call and buy the US dollar from its bank for Canadian dollar 1.50 million dollars. If, however, the US dollar weakens so that in 3 months the exchange rate is 1.1, their corporation will let the option expire and will buy the US dollars at the lower interest rate, lower exchange rate. So the purchase of the call options has capped the interest rate at 1.15 plus the cost of the options. So put option strategy for corporation. So assume a Canadian oil company will have 1 million barrels of crude oil to sell in 6 months' time and represent price of a crude oil is $70 per barrel, but unsure of what the price will be in 6 months. So to lock in the minimum sell price, the company buys a put option on 1 million barrels of crude oil with a strike price of US $68 per barrel. So this will protect the companies from an oil lower than US $68 per barrel in 6 months. The price of crude oil is less than $68. The company will exercise its put options and sell the oil to the put option writer at the strike price. So, but if the price is greater than $68, the company will let the option expire and will sell the oil at the going market price. So here, this is all of the basic fundamental of option contracts. So in this series of course, we have managed to explain the fundamentals of option contract and how to a definition using the examples. And we also learn about different strategies. We learn about basic strategies such as selling cover calls and also selling puts. And we also explains the difference between going speculative and also putting hedge against the downside risk. So thank you guys for watching for this video. I will see you in the next one. If you like the video, please subscribe and click the like button for me. And also be noted, we have a Patreon a community to join. Feel free to access our trading community. I will post trading ideas, strategies, and a lot more stuff about trading on weekly basis. Like you will see that basically on daily basis, and you see very profitable trading idea on weekly basis. And it's not expensive at all. You only cost about $50 per month for you to join, and typically you will make a lot more profit than that $50. So I guess the fee would be a nice trade-off. So thank you guys for watching. I'll see you in the next one. Goodbye.